Hello everyone, it is Bryan of Asante Capital Management, and to my right is Wilmot George, Vice President, CI, Global Asset Management, but perhaps more importantly, he's the head of tax, retirement, and estate planning for our conversation today. So welcome, Wilmot.
Good to be here. Thanks, Bryan.
As we both can see outside, it's a beautiful day. We're taping this right at the end of May, so the beginning of cottage season.
Yeah.
The whole May 2-4 weekend was, just a week or two ago, which is kind of the debut of things, and that's what we wanted to talk about today, were cottages, families, and succession planning as it relates to cottages.
Yeah.
So this is a big deal for a lot of people. So maybe start off with some definitions or lay the framework here of what is succession planning? Like, what do you mean by the word succession?
Yeah, succession planning means different things to different people. Retiring from a business, perhaps, or we're talking about estate planning, right? So essentially the transitioning of assets to somebody or some entity when we transition into another phase of life, right? So again, for individuals who might be exiting their business, retiring from the workforce, there's a succession plan quite often for that.
Yes.
And then of course we all, or most of us have assets. And when we pass away, we want to manage the distribution or transferring of those assets. So we consider some estate planning for that. And that doesn't have to happen at the time of death. I mean, there are families who consider gifting assets before death. And there can be pros and cons to doing that as well. So succession planning is generally the transitioning from one phase of life into another phase of life. And you want to think about the different tax impacts of that.
And the tax, in kind of talking before about this, that was one thing that kind of you illuminated, and that was the succession of a cottage within a family is not something you write in a will all the time. It can take place, while people are alive, and sometimes it's perhaps best done while people are alive.
Yeah.
So that's one thing that I took note was it's not just a will document of upon my demise it goes to X, Y, or Z person.
Yeah, folks, families do different things for different reasons. And depending on what your objectives are, depending on how you want assets to be distributed and when, that will define the strategies that you put in place. And some of these strategies focus on the transitioning of assets while you're living, and some of these strategies focus on the transitioning of assets at the time of death. So it really just depends on what the objectives are for the family, and that will define the strategy. Some people like to transition assets while they're living because perhaps they want to see their kids enjoy those assets.
Yes.
Perhaps they want to avoid some probate tax at the time of death, so they transition the asset while they're living. Perhaps they want to do some income splitting with their adult kids, and as opposed to transitioning assets at the time of death and being subject to tax right up until the time of death, they transition those assets before death so future growth can be taxed to the kids. So there are reasons to transition assets before death, and then there are reasons to transition assets at the time of death. Perhaps you want to make sure that you can continue to control and use that asset right up until the time of death, in which case you might not feel comfortable transitioning it before then.
Good call. And while living the transition, another thought that just came to mind is perhaps you're just not enjoying the cottage, or it's becoming too arduous for you to maintain, to go up to start the water, to clean out all the leaves.
Right.
You want to hand that off to the next generation instead of paying more people to do it.
Yeah, look, if you have this cottage in your family, and perhaps the cottage was handed down to you from your parents or grandparents, and you've had good use of the cottage, but to your point, you can't get up to the cottage as much as you used to. You can't do all the maintenance that's required like you used to.
Yes.
And perhaps your kids or your grandkids make more use of the cottage than you do. So the question now becomes, what do you do with it? Do you continue to own that cottage, and do you continue to pay the maintenance fees for that cottage? Do you continue to make all the decisions for that cottage even though you're not there and you don't use it? Or is now the right time to think about transitioning it, so that some other benefits can be realized, perhaps?
So the strategies, like a lot of things in our business, are pretty straightforward. Once you know what you want to do.
Yeah.
But you're only going to know what you want to do once you start having a conversation with the family. So, you probably don't need to sit down with the kids when they're 8 or 18 or maybe even 28, but there should be a discussion at some time of what people's level of interest is in terms of just being there, but also perhaps their financial capacity to take on a cottage. Because we all love a cottage, but some of these things can be pretty pricey to maintain as well.
Yeah, you know what? And the conversation, to your point, the conversation is important to have, right? Because, parents might view things a certain way and kids view them a different way. Perhaps parent believes that that the child wants this cottage and will embrace this cottage going forward. When in reality, the child is saying the cottage is nice, but right? But I would sooner have some liquid cash to do something with, and perhaps we're better served to sell the cottage, and perhaps the money that we get from the sale, we're better able to equalize the inheritances for all kids, as opposed to leaving the cottage intact for kids who might not agree on how it's used going forward. So there are different reasons to have the conversation. Now, people generally don't like talking about death, and I'm not here to suggest that you're only going to transition the cottage at death. We've already established that it can be done before death. But generally speaking, the transitioning of assets, the giving up of assets, and ultimately the estate planning conversation can be hard. And not everybody embraces that. But it's important to have these conversations because it can simplify the transitioning of an asset when the time comes, and it could put everybody on the same page with respect to what should happen to that asset going forward.
And I guess the conversation doesn't need to be formal. Like, you don't need to be sitting around the dining room table, when the sun's gone down, sitting down with all parties. It can be a conversation just, with your son or your daughter and say, what are your thoughts about keeping the cottage in the family for the next generation? Just casually asking.
Absolutely.
And getting it going.
Yeah, to your point, there's a couple things there. I mean, the first thing is the conversation doesn't all have to happen at once. It can happen over time.
Years.
Right? The important thing is getting on the same page with respect to what should happen with this asset. We're talking about cottage planning. We're talking about having the conversation. We're talking about it not having to be a formal conversation. Maybe the next time, you're up at the cottage with the kids and you're sitting out on the deck and you're having a drink, you bring up the conversation, right? And you just start to have this dialogue around what we should do with this asset down the road. So it doesn't have to be a formal around the table with all your legal and tax professionals at the table to have that conversation, although those individuals should be part of the conversation at some point. But sometimes it's simpler and more effective to start the conversation in a softer way and then build over time.
So that's a great way to transition into the reality of the financials of the cottage, because those can direct decisions as well.
Yeah.
Like, you need to know where you stand financially, because unlike your home, your principal residence, like, there's tax. I mean, this is a cottage is a wonderful place.
Yeah.
But in the eyes of CRA, it's a secondary property and subject to capital gains tax. Yeah. So maybe we'll just take a couple minutes and just outline, what is the reality? What is the tax treatment
Right.
of a secondary property, which could be a cottage, a chalet, a cabin,
Right.
like all those different sorts of things. So let's just go through an example here.
Sure.
So let's walk through that.
Yeah, so I think the first thing to point out is that if the cottage is being left to a spouse or common law partner, there's no immediate taxation there, right?
Shifts over.
Yeah, the Income Tax Act allows for the transitioning of assets between spouses and common law partners at cost, which essentially means you're not triggering a tax bill there. But if you don't have a spouse or common law partner and you're talking about transitioning the cottage to the next generation, for example, your kids or your grandkids, there's more often than not, there's tax to pay there, right? So if we envision a situation where, perhaps you buy a cottage at $200,000, or you inherit it from your parents at a cost of,
You did buy it. You did buy it.
You did buy it. You bought it at $200,000, what have you. And that's your adjusted cost base. Now, over time, you might put some renovations into the property. You build a deck, and we call these capital expenditures that you put into the property. Those capital expenditures get added to your adjusted cost base. So ultimately, if I bought this cottage at $200,000, and then I have some eligible capital expenditures, I build a deck and so on, hardwood floor, whatever, into the property, we add that to ACB. So let's assume that's $50,000. So now we're up to $250,000 is our adjusted cost base. And then I decide that I want to either gift this cottage to my kids before I die, or I die and my kids will receive it via my will, right? Via my estate. Well, the question is, what's the fair market value of the cottage at that time? And if the cottage is $1 million, we now have a $1 million cottage, fair market value. We have an adjusted cost base of $250,000. So if my math is correct, where does that put us? $750,000 capital gain, right?
Capital gain.
So we've got a $750,000 capital gain. And, the government says that, when we die or when we transfer assets to adult kids, for example, that tax bill is going to present itself, and we need to include that capital gain on our tax return for that year. So we include that $750,000 capital gain on our tax return for that year. That'll translate into a tax bill of somewhere around $248,000.
Call it $250,000.
Call it $250,000. So the question now is, how is that tax being paid? Remember, this is a cottage that you've had in the family for generations, and perhaps you want it to stay in your family for generations. But then you have the CRA saying you owe us $250,000, right? So where's that money going to come from? Perhaps in the case of death, there's other assets in the estate that can pay the tax. But if not, how's the tax getting paid? And a lot of families don't think about that. We're enjoying the cottage. We're making use of the cottage, and we want the cottage to stay in the family. It's been in the family a number of generations. Our families, we grew up in this cottage, and all our memories are in this cottage, and the kids would for sure want this cottage, and their kids are going to use this cottage. But the CRA says, give me my $250,000.
Who's going to pay the
right?
$250,000?
So we need to think about these things, right? Think about how that tax is going to be paid. And that's just the income tax. Probate might also apply, right? If we need to transition this asset, there could be probate associated with that as well. So we need to be mindful of these things and have conversations with our financial advisors about how to manage that so we can preserve the cottage going forward.
Because the idea of gifting the cottage to your adult children while you're alive, there's a lot of appeal to that, to me, Perhaps you're in your 80s, and again, you're not making it up as you once did, and you don't want to do all the water and all those sorts of things. So you go, I'm going to hand it off.
Yeah.
But guess who else is at the table? CRA.
They're right there.
So $250,000.
Yeah.
So you go, do I have, or do the kids have?
$250,000.
$250,000.
Right.
So it's a beautiful decision that might be impaired.
That's right.
By our friends up in Ottawa for the 250.
Absolutely. And this is why we need to have the conversation, right? This is why we need to plan for these things, right? You know, because you know what? The tax man will come calling. And if we don't plan for it, then different things can happen, right? Things that we didn't intend to happen can happen. The cottage may have to be sold to pay that tax bill when the desire was to have it in the family ongoing.
And this, I mean, this can be the dynamics of families as well, because, you know, perhaps the parents want to transition it while they're alive. It's the right time for them. Maybe they've got 3 kids, but not all of them have the means to pay the $250. Maybe the parents don't want to pay. And perhaps one of them does have the financial capacity to pay the $250, so they assume the cottage. That all makes sense on the spreadsheet. That all makes sense. But how does that impact the dynamic of the family? And so this is the art versus the science of everything. And a cottage, you know, our families splinter out. You know, we start here, then we have kids, they have kids, and you can't divide a cottage into 64 pieces.
No.
So it's challenging.
Well, and this is why you want to look at estate planning in its totality.
Correct.
Right? You don't want to just say, let's just look at this cottage and we'll address this cottage without thinking about the other assets you might have, the other kids that you have, and ultimately how you would want your estate and your assets to be distributed amongst all kids. You want the cottage to be a part of that conversation. So it's important to have the conversation, and you know, and you know, speak with your professionals, your financial advisor, your accountant or lawyer, and consider the strategies that could be put in place to ensure that your objectives are met.
So I want to go back to something a little bit more dry, going back to the tax calculations. So just a piece of advice for everybody out there. So you get your cottage. So that's a well-known number. So that becomes your tax base. So you go out and buy a cottage for $200,000. That's where we start. And then you talked about all these capital expenses that go on. You need to keep track of these, because life goes on. You put in the deck. You know, it costs you $80,000. And then 20 years go by, and you're looking for that, because it's in the owner's benefit and right to build up that adjusted cost base legitimately.
That's right.
And it's a lower tax bill. But if you just didn't keep track of anything, you're going to have a higher tax bill. Well, so you got to keep track.
Yeah, it's a good idea to keep track. We certainly suggest that because look, I mean, we've got this self-assessment tax system, right? So the CRA and the Department of Finance expects Canadians to calculate their own tax liability, pay, you know, and pay their tax bill. So we complete our tax return and we put all the information that we feel is accurate, correct, in our tax return, and we submit it. And sometimes the CRA will look at that tax return and say, fine, no problem, and move on. And then other times they'll look at it and say, we want to dig a little bit further here to make sure that the taxpayer has the supporting documentation for what they're claiming here.
Yes.
And this is where...
Isn't that an audit?
We call it an audit, that's right. And this is where... you know, it would be very valuable to have those receipts, right? Any type of paperwork to confirm that you incurred these expenses and what you paid for these expenditures, because that'll go a far way in making that audit a lot simpler than if you didn't have it.
Okay. So you got to start the conversation. You got to know the chess pieces. You got to know the financials to help make some of these decisions. And we can certainly help define all those different things. Right. Got to start thinking about it right now. You got to start keeping track of things. I'm going to switch gears a little bit from succession onto just another idea around the cottages. I've witnessed many clients who are saying, you know, I live in the GTA. I've been here for, you know, decades and decades. I'm going to cash out of my home here, and I'm going to move up to the cottage on a more full-time basis. So now I'm going to make that my principal residence because I don't want to pay tax on it. So tell me about kind of designating your cottage or your secondary property as your principal residence.
So I'm assuming for the purpose of this conversation, we're not talking about a rental property, right? We're not talking about earning income off of these properties, right?
No.
We're just
family cottage.
We're just considering family cottage, and you have a primary residence in the city. You've got a cottage, up in Cottage County, what have you. And now you've lived in your city home, we'll call it your city home, for X number of years, and now you're thinking, hey, let's make the shift and let's spend a little bit more time up in the cottage. So now the question becomes, what happens at that point in time, and how do we claim the principal residence exemption?
How do you do it?
How do you do it? Well, the good news is you really don't need to entertain the conversation of which property to claim as my principal residence until you sell one of the properties or until you die. Okay. So it's not like at the time that you decide I'm leaving my city home and I'm going up to my cottage, what do I need to do at that time? The time when you make the decision around the principal residence exemption is when you sell either property or you die. Now, you can only have the principal residence exemption for one property per family unit.
Yes.
And the principal residence exemption, a lot of folks don't realize this, it's actually determined on a year to year to year basis, right? Depending on whether or not you occupy said property for some point in time throughout the year. So the truth is, you can go ahead and you can start to spend more time in your cottage. You don't have to make the decision as to which property to claim until you sell either of the properties. And then at that point in time, you go through a calculation and you do what you need to do to report accordingly.
But if you are gonna swivel, it would be good to have some sort of documentation to go, the cottage was valued this much at the time that we did this, and how do you do that? And do you get appraisals? Are those real estate comparables?
Listen, it's always a good idea to have a value of what the cottage is or what your city homes are at any particular time. Mm-hmm. But the way the calculation generally works here is they take a look at what the property was worth when you bought it or inherited it. They take a look at what the property was when you sell it. Mm-hmm. The difference is a capital gain. And then what they do is divide that capital gain over the entire period in which you held.
Slice it.
So they're prorating it or averaging it right across the number of years in which you held it. And then what you do is you say, I'm going to apply the principal residence exemption to each of these years. So that's kind of how they do it. So that saves you having to get an appraisal this year or that year, and as it goes up and down and up and down, you don't need to go through all of that, because what they do is they look at the beginning, they look at the end, and they average it out right across.
So you're not in a pit full of mud if you don't have these appraisals. Okay, correct. So that's good.
Yeah.
That's wonderful, Wilmot. Thank you so much for having this conversation today. Let's have this conversation around cottages and keeping them in the family. And if we need to bring in some expertise, we'll bring in some expertise to talk about it. Thank you very much, everybody. And if you have any questions, please let me know.